Futures and options on futures trading involve substantial risk and is not a suitable investment for all types of investors. Past results are not necessarily indicative of future results. When I use the word I in this video, it refers to what I teach in my charting course or what I author in my twice daily oral and written updates. Prices shown on charts and quote boards are in real time and take into account all known activity up to this point in time. And if you'd like to read more of this disclaimer, simply hit the pause key on your video player.
Good weekend, all. Ira Epstein of Linn Associates with your weekend update for this Friday. And this is going to be your weekend version for Friday, the 23rd of February, 2018, of the financial markets. Now, do you think volatility's gone away? 300-point rally today in the Dow, 37 points higher in the S&P, 121 in the NASDAQ, 13 in the Russell. I mean, it just hasn't gone away. And look at the size of these ranges. You've got a 350-point range. In this market, you've got 100 and what is that? Really 130-point range in the NASDAQ. Volatility has not gone away. So the question is, do you get follow-through on any of these markets, or do we just keep meandering back and forth? And sometimes the smartest thing you can do is go to a weekly rather than a daily chart, and even overview a monthly chart every now and then. So this is a monthly chart of the Dow. And the one important thing on this chart is what? The trajectory has been up. The second important thing is you haven't even approached hitting an 18-month moving average of closes since back in 2016. That's the first thing. When we go to a weekly area chart of closes, you see the weakness that came into the market. You went from 2874.50, and if we come back here together, I'll go right to that low, to 2529. So you did drop in this market 3,000, well, yeah, 350 points. I said 1,000. 350 points. Off that low of 2529 now, you have come back 200. So roughly two-thirds of that break that you've seen just recently. It's just massive, the volatility. If the market fails again, I wouldn't be surprised if we get back to that 18-week moving average of closes. I know I said day. I just saw it myself. I should have caught that. When we come to the weekly bar chart by itself, you've got a high, then you come back up, and now the question is, which way does it break out? Is it going for the highs here or back for the lows there? I'll let you figure that one out. But if you see that, how clear that break was, and now that you've bounced back, what's the next phase? When I take a look at the swing lines, you've got a high, a lower low, a bounce up, and now a pause. Now, I could actually take from this high and drop it right here. And that would be the right thing to do. But I wanted to make a point to you. If you now take out 2754, you will end up with higher lows and higher highs. You're back into the uptrend. We've already seen that the market has gone to and held 2 weeks in a row retracements into the 18-week average. So is the market maybe to possibly bounce from there? Well, it could. The 100-day average is under the market, so I don't have another moving average over it. Where I'd have the resistance sort of makes sense. It's just under this high back here at 2858.40. So I can make the argument that if the market takes out 2754, as long as this low is not taken out afterwards, got what I just said, that's a big important word, that becomes an active target to the upside. Momentum is still, it was pointing down, and because this is a weekly chart, not daily, you don't go the word still, you go flattened out. It began flattening out. If you can see that big break, it started pointing up, and it's continued with that trajectory so far. So I'll not say that it's crossed over bullish. It has not. All that it's done is given you a bounce with it. I really need to get the red line over the blue to make that statement that it's starting to turn up again. It hasn't at this point. A battle at the 18-week moving average. If you get higher over last week's high, not this week, last week's high, I could argue that the 2858 is a target. If you get over that, though, and you come back down through this low, it could be a trap. So at least we know a number. We know two numbers that should be important. That is not the same pattern that you have in the NASDAQ. Do you see that? You have the high to the break low and just a rally back. You're not trying to set up a trend. You're just whipping back and forth. 2 weeks we went to the 18-week average. We didn't even attack it this week. We just started going up again. The Dow is very, very similar. In fact, it's the identical pattern of that of the S&P. And you can see where you've got. I could take this arrow, drop it here, argue that if you get over this number, the 25,424 level, as long as you don't then after that come back under this low, you'd have higher lows, higher highs. The key is not to then get back under it. The reason I say not get back under it, you can see that for the week, it closed near the week's highs. And that's the important. You were up on the week, 78 points. So today's 300-point rally really brought the market back into positive territory. The Russell is like the NASDAQ. It's got the higher high, lower low. It's amazing that they've separated themselves into these categories, and its battleground is the 18-week average of closes. In the VIX, will the market call all this just noise and we go back down and challenge 1260? There is an investigation right now going on at the Security Exchange Commission and the CFTC to see if any wrongdoing occurred when the market went out of nowhere, basically, soared to 50.3 and then started collapsing. The problem is that first of all, there's charges by some people that the CBOE, it can be rigged on the volatility index. I don't know about the future side, but that is what I read in the paper for how the cash. Not by the exchange, obviously, by doing certain things in certain vehicles. I don't even know if that's true, so I'm just reporting what's there. The investigation, I read it in the Wall Street Journal. I've read it on CNBC. I'm assuming it is the way that it is going. But you get these remember the word flash crash? Well, what's wrong with the flash to the upside? I mean, I was involved in flash crashes in my career, and nobody came out and rescued me. In stocks, they rescued the people, but not in the futures, the indices of it. And I bitched like there was no tomorrow when that occurred. Not much you could do. I wonder if this is going to end up in that category. Just don't know. But obviously, the market pulled back in no time at all. Literally, if you take a look at this, it came out of the upper Bollinger Band, exploded, came back, challenged it again, went right back under it, and it has stayed under it so far. What was this is what people are going to ask. When you come to the 10-year notes, you were unable to continue going on. Now, does that mean that all of the debt that we sold this week was enough that in other words, if you were listening to the daily updates, I kept saying, when you have an awful lot of debt that you're selling, you have to price it in a way to attract the buyers. Once you don't have to sell that debt that way anymore, the yields fall back a little bit. Is that what we're facing now? Or is this just that the market finally got back over the Bollinger Band? If we take a look, you know my theory that we don't stay more than 5% of the time under that. It's not mine. It's the theory of this. We were under the bands right here. No. We had closed over it. And that's the important thing. The lower band is, in this case, 120.17. You closed 18.5. So the market didn't need this. It had already corrected itself. It's a follow-through, but it isn't going anywhere, and momentum hasn't begun turning up. So I still wonder what we've got. In the dollar index is trying to turn the momentum up. Notice how the number's back over 20. So if it carries, the market should, in theory, take out then 90.45.5 and maybe make a run to the 18-day average. That's an awful big run, though. It's 200 points. So I have my doubts about it. That's such a big number. We'll see. But what is the trend? Until you take out 90.45.5, I've got the lower highs, lower lows, or do I? This low's 88.15. This low right here is 88.25.5. So do I have that? I really don't. What I have in the market is the overall legacy left of the lower highs. But with this week, we've now got a pattern of higher lows. In other words, the market was going like this, and all of a sudden the lows are coming up. So we're getting into a wedge formation right now. That's important to understand. In the euro still has the longer-term pattern of higher lows. If we look at this high, 125, and right here, 125.79.5 to this high, I went too far. 125.76.5, you still have the higher lows, higher highs. Take out 122.33.5, you put this market in jeopardy. Momentum's already starting to point to the downside, but the bias is up since you're over the 18-week moving average of closes. In the Aussie dollar, it's a clear-cut pattern of higher lows and lower highs. You're waiting to see how the market comes out of this. Canadian dollar, bearish. Lower highs, lower lows. You have to go back and take out the high right here, and that week's high, let me come to it for you, was 80.34.5. Until that is taken out, you got the lower high, lower low pattern. You're under the 18-week average of closes. Unless that's taken out, you've got live numbers that maybe could offer the support at 77.12. That's quite a break from where you're at, but that's what the market's saying. In the Japanese yen, the longer-term picture is still one of a bull. The market's got the clear pattern of higher lows, higher highs. It's running against the upper Bollinger Band, not backing off from it, and momentum is staying bullish. In the Bitcoin, this is the weekly bar of Bitcoin Cash, not the futures markets, because I can't go that far back yet. They only started trading in December. This is how narrow the cash did look back at this point. And it started coming live, as you can see, in 2017. It was actually around February and March that it really started to come alive. Then it got to the crazy numbers that we saw, lost 2/3 of its value, went from almost 20,000 to 6,000 roughly. Now it came back up. It challenged the 18-week moving average of closes and did not get over it. What also is the longer-term part? Lower highs, lower lows. It is still very much in the bear camp. In the weekly close of crude oil, we've done something interesting. The market has defined, for the moment at least, that $3.13 is a low point in that spread, and suddenly that's turning back up at this point. Now, I was asking on the daily videos often, I said, is it $1 a barrel to ship from the U.S. to Asia? I don't know the right rate. I've talked to people, and they said I'm probably in a ballpark with that. So if that is the case, that differential, as we were up here in 6, I kept saying there was a big spread that you could make on it. But if you're just covering your shipping costs, that spread's starting to say, well, that's gone. The prices are basically equal, less, of course, the transportation. When we take a look at the Brent crude, you don't have a trend. You've got a lower low and a higher high, and momentum that flattened out, and that's all that I can say about it. And it did it against the 18-week average of closes. In the weekly crude oil, you still have the pattern of higher lows, higher highs. That part's bullish. Momentum is not with it. Momentum has not turned the corner back to the upside, but the bias is up. The key in this market is 58.07. If the market were to roll over and take that out, you probably could argue that you've got a top in the market. I can't make that argument at this point. In the nat gas, it's interesting that we came down on the weekly charts here, and we can see right here to 253. What was this low is what you should ask yourself, and we'll go to it. And that low is 256.80. So we made, on this break, a higher high and a lower low. That's hard to figure out what to do with. The zone of resistance is, I think, very, very clear. The 18-week average and the 100-week at the 290 level, if you rally back up, that probably is your resistance area. So when I look at it all and try to figure out what to do with it, that's where I'm at this point in time. Now, I did write my gold report, and if you're interested in seeing that gold report, I'd love to put it in your hands. You can get it by giving us a call or go to our website, and you will be able to see from there the report. Now, I did not include the seasonals. It's all about price counts. And on the price counts, I used a weekly chart. And I'm showing you upside breakouts and downside because sometimes, and that's what my point of this report, momentum is more important than price. And the market's looking for momentum. So give us a call. We'd like to put it in your hands. If you haven't received it, believe me, it's not coming in the mail. I'm not mailing them any longer as email. So you have to get hold of my staff. They'll get it to you right away. You can click up here if you see me on YouTube, by the way. Other than that, I'm Ira Epstein. Have a great weekend. I will see you all come Monday. Take care.